Okay, we are recording. Today we're going to be watching the ICT 2022 Mentorship episode 3. And it's 52 minutes long, so it's kind of a beast. I'm sure there's going to be an absolute ton of content in here, and we're going to do our best to take notes on it and make some figures. Okay, so now that we've watched, I believe, the portion of the video that has the most learning material, we'll go back and we'll start to create our notes and try to extract as much as we can. Yeah, so let's get to it. All right, let's walk through my notes really quickly. I'm losing my light. So, image 1, 15-minute time frame. We are establishing buy-side and sell-side liquidity. Old lows and old highs, old highs. The appearance of equal highs supersedes a previous local high, especially if price rises above the level of the previous local high. And what I mean by that is, you see we have these 2 points here, right? They are at the same level as this local range high that we have with this blue line here. Now, if these 2 points were above the local range high, then we would use that as the level of interest that we are looking to breach before establishing a market structure shift. But we don't really have to worry about that because all of these happen at the same level. So in fact, it's actually more reinforcement that this is the level we're looking to breach. Okay, when do we begin to look for market structure shift? We see price run through or clear or breach a liquidity level. A market structure shift may appear or it may not. Okay, so when we see price running down through this local range low, that kind of gives us our cue that a market structure shift is possible. So, you know, we kind of perk up our ears or whatever. The chart has our full attention, okay? But then we run up and we breach this other liquidity level, the local range high. Now we're really looking. Now we're really eager to go, okay? So we shift over into the 2-minute time frame for a deeper analysis. And now we really start to establish, as I say, points of interest. And these points of interest are, other than the local range low and the local range high, are the swing highs and the swing lows that are formed, you know, in this price leg. You know, this one here and this one here. We're zooming in on how price moves just to get our, you know, to establish where the liquidity within the price range lies. So we have the liquidity below and above the price range, and then we also have liquidity within the price range. These will form the targets the price is drawn towards, depending whether it's in a bullish or bearish market structure, but we'll get into that a little bit later. Okay, 1, look for price to enter buy side or sell side liquidity area. That would be down here. So this would be our buy side liquidity area, if I'm not mistaken. Okay, i.e. it is trading above or under the retail notion of support or resistance. So for the retail trader, this would have been resistance, you know, and this would have been support. And at this point, we are trading under it here in this area. Okay, look for the previous short-term swing high or low. In that case, it would be this. So we have the close, or the high of this green candle here, the high of this red candle here, and then the high of this second red candle here. That forms a swing high, you know. A very small swing high, but that's all we're looking for. Look for a candle that takes out the short-term high or low. Okay, so here's our level. And in this case, it would be this candle, this green candle right here. So once price, I guess, closes above that, then we have the, well, we form the order block. I don't know if I want to explain that right now or wait till a bit later. Okay, fair value gap is created. Yep, that's true. Trade entry based on the fair value gap. Profits, okay. I guess I can explain that in this slide because I don't think I have it summarized in another slide. Okay, yeah, so we're actually going to take the downside movement as our example here. So again, starting from step 1. Look for price to enter buy side or sell side liquidity area. In this case, it's entering the sell side liquidity area. Okay, it is trading above. In this case, it would be trading above the resistance. Look for the previous short-term swing high or low. Excuse me. This would be the swing low right here. Right? Yeah, I think so. Okay. A fair value gap is created after we break, or when we're breaking this swing low. We're creating this fair value gap or imbalance. Remember, that's just the area that's not covered by the previous candle and the subsequent candle. It's this gap. Okay. And then we would look to enter our trade when price returns to that fair value gap. Yeah, and this would be a market structure shift. All right, and then he sort of talks about what an order block is and the significance of an order block, and then he sort of chastises the other teachers on YouTube who pretend to teach order blocks, you know, and he might have a point. What can I say? Okay, so what can I talk about next? We're at 5 minutes 48 seconds. Order block entry. Okay, I might return to this slide, but let's hop over into the second one. Order blocks 1. That sounds promising. Okay, and this 2-minute time frame is exactly what we were looking at the previous slide. So we have our breach here, you know, fair value gap here. Yeah, it would be there. Okay, so this is the first time that he mentions an order block in the series. It's, you know, I guess it's kind of what he's known for is these terms. So anyway, the way he first introduces the concept of an order block is, let's see, a series of continuous down or up closed candles that penetrates the liquidity zone. So coming back to this area here, he's explaining how an order block is formed from these 3 candles. Okay, so we're penetrating the liquidity zone. These 3 candles they're all closing red, they're all the same color. And then we violate the short-term high, as I had on the previous slide with this candle here. So this short-term high that we talked about, right? And we're violating it here. Once we violate it, we expect price to reverse, and I won't use the key phrase that he uses because I'll use it a bit later on. Okay. So yeah, at that point, these 3 candles, they become our order block. And we are measuring from the open of this candle, not from the high. He doesn't explicitly say why, but so just take that at face value for now. Okay. Blah, blah, blah. Series of down closing candles. What do we say here? This is where the sell stops are placed. Yeah. Fair value gap. Oh, wow. I should have been explaining it here. Okay, so here's the swing high. Here's the break of that swing high, here's the fair value gap, and here is the order block drawn in purple. Okay. And I will also say that price does not necessarily have to close above this swing high. It just has to break it. So it could just be a candlestick that come up here and broke it, and that would be all that's required. All right, which one is that? Order blocks 2. So then he gets really into what I find to be the most interesting part of the lesson, and that's explaining what exactly an order block is. Okay, so an order block, let me fix that. Order block, yeah, is a change in the state of delivery from buy side to sell side or vice versa. The idea is to identify points of sensitivity by identifying where the changes in the state of delivery occur. At the open of the first candle in point Q, and this is just my paraphrasing of him, so if it's incorrect, well, forgive me. Okay, so at the open of the first candle in Q, so this is our Q box, this is our first candle, the market begins delivering price lower and lower, so this would be a sell side move, so bearish market structure. Once price trades above that point, above the open at point R, there is a change in the state of delivery from sell side to buy side. Okay, so here we are at point R. Yeah, and this is the 1 minute candle, I think. Yeah, I think this is the 1 minute candle, so that's why we have more bars here. So at point R, we are switching from sell side to buy side, from bearish market structure to bullish market structure. And this point R, this level of R, is, as he says, remembered by the market as a point of sensitivity. And this is repeated again at this point up here. So at point S and T, and I break it down in this little box. In this case, we are in bullish market structure with these two bars here. And then at the break of the open of that bullish market structure, point T, we begin to switch from buy side to sell side. So now we will be seeking lower lows as opposed to higher highs. And I sort of denote this with this green shaded area and this red shaded area. And don't get me wrong, these swings here, they also represent changes from bullish to bearish and vice versa. It's just, it would have been really hard to mark that. And I think the primary ones are the ones, for the primary changes of interest in market structure are going from the bottom of the range to the top of the range. Yeah, so I didn't bother, marking all this. Okay, all right. And this might be the last key point. When the algorithm is offering buy-side liquidity, it is drawn to buy stops. When the algorithm is offering sell-side liquidity, it is drawn to sell stops. So once we switch from bearish market structure to bullish market structure here at point R, we are going to start seeking these buy stop levels that we established on our way down in this price leg here. Okay, so these would be the lower highs on this way down. Shoot, sorry, I gotta pause. My pizza's ready. All right, we're back. I don't know if the camera can see that or not. Look at that. Delicious. So that'll be waiting for us when we finish summarizing. Okay. So where was I? Algorithm is looking for, right, okay, so we are in bullish market structure and we're looking for buy stops. Yeah, so we're hunting these levels here on our way up. Yeah, and you can play the game of, shorting at the buy stop level and then buying at the sell stop levels if you're good. If you're not, then maybe don't worry about it so much and just try to catch the bulk of the leg, the thigh and the calf, and yeah, so the bulk of the leg. Don't worry about getting all the nitty gritties. Okay. So yeah. Anyway, so we switch to bearish market structure at point T, and then we're going to start looking for the sell stop levels, and these would be the higher lows on the way up to this breach. And this level here, he draws special attention to. Notice we do kind of like bounce off of this level here that seems to be acting as resistance. And that is actually, according to him, a way of engineering liquidity for the smart money or the algorithm or whatever, who bought down here as a way to kind of just squeeze people a little bit more so they can sell up here and then sell short for just that extra little bit on the way down. Yeah, am I missing anything else? He also talks about the time that he looks for trades. I believe he says his... yeah, somewhere in here. Anyways, yeah, so just look for the, and this will be part of the homework, so I didn't really pay too much attention to it because I will be reviewing it to try to reinforce this a bit more. What are we at? 15 minutes! Holy cow, I've been talking for 15 minutes? Okay, yeah, so I think this is as much as I want to cover this. Change in the state of delivery. be back here. Okay. Bye. I'm gonna eat my pizza.